Hi, this is Paul from globaltradingsoftware.com, and this is a trading tutorial video using our opening range breakout indicator along with the manager, looking for those big moves. So one of the things that we do is print the range continually. So I'm going to just move this rectangle out of the way a second. So this is the gold European pit open. That's at 8 a.m. European time. It's printed in red and the range is in red, so we're looking for a short trade. This green rectangle here is 15 ticks. So when we're devising a new auto trader for this, we're looking at just taking 15 ticks out of every trade, and that, as you can see there, that was very easily done. Then the price action comes back up through. Not only does it come back up through, but the bias for the range turns yellow, so we're looking for long or shorts at that point. So you can go long, breaking out to the upside. You see how the range turns green? That means we're only looking for the longs. Go long, 15 ticks, away you go. Okay, nice little winner there in a few minutes. We come back down through the range turns red on this candle here at 12:25 p.m. European time. We then break the below of that range at 12:45, so we're looking for short because the range is red. That short just keeps going and going and going, and it's still in now. You see the New York gold pit open here. This is the first 5-minute range candle. It's printed in red, so you're only looking for shorts. The range is in red, so only looking for shorts, and away it goes again. So when I say that 15 ticks, that would be for auto trader. If you're using this manually, you would use the manager. Let's talk about how you would use the manager in this case. So when we get the gold pit open, we're red label, only looking for the shorts. Go short here, and we use the manager. Now on the manager here, we've got it set on day trading moderate. Okay, one of the things you can do is just adjust it to day trading aggressive. Okay, because this is a breakout strategy. When gold or oil or whatever you want to use it for breaks out, it breaks out with a lot of force, and when it goes, it goes. So if it doesn't go, you want to use the aggressive setting on the manager. So we entered this trade on the short from the European gold pit open at 1824. You see how the ribbon turns green on the manager at this point here at 1823.2. So that's when you would take the profit. Okay. Now on this long trade, we go in at 1826.3. It changes to red at 1826.6. So no losing trade there, not a big trade. But then look what happens. It comes back through the opening range. The opening range turns red. We're only looking for the shorts. The entry is at 1824.10. And it's still in, it's just being taken out right now. You see this? The ribbon is just turning green right now. So this would be the time to take off that trade, or if you're trading the New York gold pit open, you'll be taking off that trade right now. So let's measure that. So let's go for, if we traded this European opening range there, I mean, to be honest, if it's not that early in the US morning, so we'll move that down, and we're just taking profit right now at 235 ticks from this entry here when we came through the European opening range again. What is it from the New York gold pit open? 127 ticks, not bad, very good. So again, it's about using these two indicators. I'm going to put the links in the description there. They're available for NinjaTrader and TradingView at this moment in time, and Motivewave. So for three platforms at the moment, we're looking for opening ranges, and that could be gold, oil pit, the index is open, and this was an example on the gold pit open. There's two. There's one for Europe and there's one for New York. And the idea with our opening range breakout indicator is the range continues to get printed, and the bias for that range, you see it changes from bearish to neutral to bullish to neutral to bearish. If you missed that initial and you just trade the US session, New York Gold Pit Open, there we go, 8:20 a.m. New York time. That's the opening range. It's printed in red, the tag. If the tag's printed in green, we're only looking for a long. The range is in red, we go short, and we use the manager on the aggressive setting. Only use the manager on the aggressive setting because it's a breakout strategy, and it's just trending to the green again. I'm just going to zoom in there. We see the ribbons just change to green at this point. Again, if you'd have taken the early trade, 235 ticks, taken the New York trade, 127 ticks. So great trading opportunities. But the main thing is combining, not just for safety, that manager, but also for maximizing profits when it does run, not panicking. So at this point here, when we get this big move down and it pulls back up slightly, it's pulling back up with these blue dots underneath. That's lower than average volume. Okay, then we start to move down again. We do get 2 candles on higher than average volume, but it runs out of juice and comes back down again. The ribbon stays red even on the aggressive setting. So yes, you can get in the trades and the trading that opening range for gold. You can trade platinum on those gold pit opens as well, or oil. You've got to maximize those. So we've got a great strategy for getting you in the trades, telling you which way to go, whether it's short or long, with that opening range, and continual trading opportunities during the day. But more importantly, check out that manager. That manager, you combined with this opening range trade, will really help to maximize those profits during the trading day.